Now we're going to start getting into the financials. I know we've talked about this a little earlier about financials, and so many times when I'm working with entrepreneurs and startups, you start talking about financials and they're like deer in headlights, or they go talk to my accountant. Well, that's not right. It's your business. You need to understand the financial situation of your company. It is the lifeline of your company, is understanding that's where the revenues go, that's where the expenses go. It is understanding the operations and how efficient you are running your business is through the financials. It's a very important part of your business, and that's how so many business will go under, because they don't understand. You don't necessarily have to do all the accounting and the bookkeeping, but you need to understand the essentials of it. So this first little module that we're going to go through, we're going to go through just some basic terms very slowly. And then after this, there'll be an example of going through some startup costs. So let's get started and see where we are. So we've done the introductory, where we've talked about some of the pitfalls, why people fail. And if you remember, in that very first introduction, we talked about one of the major reasons why companies fail. One of the top three is not having enough cash. And that's because they didn't understand their cash position, the expenses of their business. So with this module and the next one that we're going to do, we are going to get you through that. So we're going to help you understand that. So that is not going to be one of your problems that you're going to have in starting your business. We talked about the business model canvas. And we've already talked about the revenue side. So now we're getting to more of the cost side of the business. We've done customer discovery, looking at how to go out and talk to our customers to validate all of the different sections of the business model canvas. We've done a competitor analysis to look to see if there's any other opportunities out there that our competitors are not currently addressing. And then in the go-to market, we talked about the revenue streams and how that we want to have that reflect our business model. So now let's get started on the financial analysis and looking at assumptions. So here we are, starting with the first thing you want to do when you're starting a business is you want to estimate your startup costs. How much is it going to cost me to actually get this business up and running? We want to look at what is absolutely necessary in terms of bootstrap and what would be a luxury to have. So you need to know, what are you going to need? What type of cash are you going to need to start this business? And we want to start looking at this. This is not a cookie cutter type of activity. Everything will depend on your business and what you're trying to start. Not every business is going to have the same startup expenses. It depends. If you're doing a web-based business, your financial startup expenses are going to be so much different from somebody starting a brick and mortar business. So we need to look at this in your particular example of what you are trying to do. Some businesses can start with a very small budget, and other ones are going to take a very large budget. And that's something that you've got to look at. And hopefully by going through your value proposition, you're doing your customer discovery, and you're finding what that lowest hanging fruit is in terms of going to market. It might be a smaller scaled business. And that as you start hitting more target markets where the problem is not as hair on fire as that initial entry point, then your business may grow as well, maybe from a smaller location to a larger location. So you also want to keep that in mind as you're working through your business and starting and working through your assumptions and the goals that you're working with. So that's what we need to be looking at here. So estimating your startup costs is a very important step to get started. And I really encourage you to use an Excel file in order to start this up, or it could be numbers or whatever, but some type of chart that you can list out what they are, who the vendors are that you're going to get those expenses from, and if it's a one-time expense or if it's a recurring expense. Seed money. So you're going to have these startup expenses. So how are you going to fund those startup expenses? Well, we want to have some seed money. And the seed money is how much money you're going to get in the first few months either right time before you start business or in the first few months of actually having your doors open for business. There's a lot of different ways of getting funding for your business. Um, there's the one they call friends, family, and fools, right? That might help you out in giving you money to help you get your business started. There are loans that you can get from banks. But some of the general rules of banks, if I remember correctly, that you've got to have a credit score of at least a 590, I believe. So you need to look at your credit score on that before you do it. Also, what banks in general are going to be looking at is that you're putting at least 20% of the seed money, the initial money, in yourself, meaning that you've got skin in the game, that you also have an important financial investment in your business as well. Because with the bank, they don't want to have the financial responsibility of your business if that's all they're doing is giving you money and that you have nothing else to give in there. They're the ones that are going to lose it all. They want to make sure that if something happens at business, you have something to lose as well, so that you have a better chance of being more successful. So keep that in mind. So you could be going to a bank, you might go to get a loan of some kind. Many times I get asked about grant money. Grant money is very specific for specific businesses. Now, if you have a technology-based business, there are programs that they call SBIRs and STTRs, and they're based, they are from the federal government, and they will help you start your business, but it has to be technical based, and it has to be very specific to an agency that is given that funding of something that they need to be in a business to help them in the future. So you can look into those, but they're very specific and for very high level technology based types of businesses. For more of your retail type of level, there is very few grants available, but you can look for them. There are other ways of getting seed money. You can raise it like go to FundMe. People have done that. Some of the crowdfunding type of websites. I've seen that happen. Like with the crowdfunding, what you might be doing is have people pre-buy their actual what product that they're selling, and you won't get it for a year and a half. But if you pay that money now, we will, then be able to manufacture it and send it to you. The author of the book, Business Model Canvas, he funded his book that way. As he was writing his book, he asked for money from people. If you want to be a sponsor and be listed in this book that's going out, and send me money. And that's how he funded his book that he sent out, was that he had people give him money as he was developing the book. So look for other creative ways of getting funding for your business. There's not always the traditional ways, but there's other ways. So be looking out for those all the time. And again, when you're looking at some of these different money, even the expenses that you're looking, which ones are ongoing expenses, which one will be occurring regardless of whether or not you have any customers or not, which ones are related only if you have a customer, which ones are essential to the business, and which ones would be nice to have if you had the money. So really look at some of the seed money about where you can get money to help you start your business. So looking at expenses, I know this is very basic, but let's start there anyway. So defining expenses, we usually have fixed or variable. Fixed expenses are reoccurring expenses at a fixed amount. They're usually at the same amount every time that we have it. Fixed expenses there's some great examples right here: rent, utilities, administrative costs like salaries of administrators, the business, insurance costs. Yes, they might vary, but we can look to see they would be within a range of what's going on, maybe seasonality of something of that sort, but we still call them to be fixed expenses because they have to do with the administration of running the business, we normally put them in the fixed category. Variable, on the other hand, are those expenses that are only related to us having a sale of our revenue stream. What expenses do we have to incur in order to have this revenue stream of, which is a direct sale of our product or service? And those are usually our variable expenses. So going back to startup costs, let's go back and list some of these. As I mentioned before, I really encourage you to list it out. Make sure you list all the assumptions of your startup costs, which ones are assumptions and which ones are facts. Do you actually have a reference of knowing that is a specific expense? That's how much it will cost you. We want to look at what are those expenses that are related to actually opening the doors of your business. And that means start selling. What is it going to take for you to start selling your product or your service? And again, the most effective way to calculate your startup costs is to use a worksheet, use a worksheet that lists both one-time and ongoing expenses. So again, let's go back and look at source and use of funds. And let's talk about them just a little bit more here on this particular slide. So of the money that you've identified of starting the business, that is going to become equity. If you get a loan, that will go under our long-term liabilities or under our liabilities section. So when you get money from friends, family, and fools, that portion, it will be going into your equity position of your business. What you have to decide is that when you do receive that money, are you going to give anybody a piece of your business, a percentage of your business? Normally, friends, family, and fools, you are not giving them an actual position in your business or giving them a part of your equity, but that money does go into equity as if you had given that money. You might be agreeing to make it a loan, in which case that would not be equity, but a loan. So you want to look at how that money is coming in and how it's going to be used. So really keep that in mind, that when you do take money from your friends, families, and others, that whether or not they want to have an equity position in your business or not. And if they're going to have an equity position in your business, really think about how you're valuing your business, and how much equity you're going to give them. I encourage any of my entrepreneurs that are taking on investors, if it's your business and you want to keep it, don't ever give away more than 50% of your business, or really 51%, because that way you're the majority owner. And thinking about that, if, for instance, you might want to go to angel investors or a VC, a venture capitalist. Angel investors are normally less than $250,000. About the $50,000 to $100,000 range is normally about for an angel investor. Angel investors then become mentors, and yes, they will take an equity position in your business, but they come on as a mentor to you and your business. Normally, when you go into a venture capitalist, you're talking about over $1 million, 1.5 and above. When a venture capitalist gives money to a business, because they're putting so much money into your business, it is not unusual for them to replace your management team with their management team, because now they have the financial risk of that business, and it's now become their business. They might keep you on in a advisory role, or maybe in a lesser management role than what you've used to when it was just your business. But be prepared for that. If you go to a VC, they're going to be taking over the business because they have the greater risk of your business than you do. So the amount of equity you give somebody is the amount of risk that they have in your business. So another way to think about it. So when you're getting these funds from these different sources, you want to think about how they're going to be used. Where is it going to be spent on? So one of them might be capital, any equipment that you might be having, any buildings that you might be having, any land. what any type of fixed assets that you might have, like tangible assets that you can touch that you'll have in your business. So you want to think about how you're going to be spending. Are you going to be spending on fixed or variable expenses? Which of those are you going to be spending it on? So you really think about how you're allocating this money. Then we have to come up with something called sales projections. Oh, the hard part. Yeah, the sales projecting. Now you're trying to be a forecaster, right? You want to see into the future. How much money is that revenue stream going to yield you in the future? Now, when you're starting to come up with these guesses, it's real important for you to document how did you come up with that forecast? How many sales per day per person are you expecting? What is the sales range or the dollar amount of revenue per person per day? You need to really understand exactly how you come up with those sales projections, because people are going to be looking at it and they want to understand it. Now, investors, loan officers, and others, when they're looking at these sales projections, they know they're wrong. We all know they're wrong because we're guessing the future. The future we don't know. But what is so critical here is about the assumptions. What assumptions did you make in coming up with those projections? That's what investors want to see. We need to understand that those are reasonable assumptions, that you have some basis or underlying estimate for those estimates that you came up with. What was the judgment, the thought process? If there's faulty process in there, they're not going to believe anything else. So it's very important that you really understand those sales projections, because that's whenever you go to an investor, whether it be like in a business plan competition, an angel investor, a bank, somebody giving you a loan, mom and dad, whoever it might be, there's 2 pages they look at. They look at the executive summary and then they go straight to your financials. Then if they like your financials, they'll look at the rest of the business plan. But that's the order they're going to look at it. They don't want to see it written in that order. They want to see in the order that we're presenting here a little bit later in our last module, that when you take this information, your financials, to anybody, for them to evaluate your business, that's how they're going to read it. It's kind of like reading a really good book. You read the little bit, find out what's going on, you jump to the end to see what happens, and then you go back and read the rest of the book. But you only read the rest of the book if you like the ending. So keep that in mind. It's all very important. But when it comes to the sales projections and these initial cost expenses, they've got to be solid. You've got to have solid basis, facts to build these on so that people will believe them. Cost of goods sold. These are all the expenses that are directly related to any of your sales. And again, we were talking about these being variable expenses. But these variable expenses, we want to see how you're doing your cost of goods sold. Recently, I was looking at some financials for a business, and somebody put in to their financial, in their cost of goods sold, depreciation. Depreciation is not directly related to sales. You're going to have depreciation regardless. So make sure you understand, what does it take to make it? Yes, you have to have that equipment in order to produce an item if you're manufacturing something, but that equipment you still have regardless if you're selling anything or not. So that depreciation is not directly related to your cost of goods sold. So we're looking at, what does it take to make it, and trying to understand how it breaks down. And then you want to think, we're going to be talking a little bit later about cost of about your break-even point, and we could talk a little bit about that later on when we get into it. But this is where we're going to look at, how are you going to make that item, that service? What are the direct expenses? Now, if you have a service, it might just simply be your time, but you need to think about, would you have that time in the business regardless if there was a customer or not? If you would have that time at that business, regardless if there's a customer or not, that it does not go under cost of goods sold. Cost of goods sold are only those expenses that you would incur if you have a sales or you're building something for sales. Asset assumptions. We want to look at different types of assets and how you're going to be utilizing them. What are the efficiency rate? I've seen some studies or some businesses that when they're looking at the assets, if it doesn't have at least an 80% efficiency rating, meaning that we're going to use it 80% of the time in the business, that they encourage the person to lease the equipment instead. So looking at your assets, how are you going to be using those assets and how are they being used in the business? If they are used just sporadically, think about looking at the cost of leasing it and only leasing it when you need it versus actually buying the asset. So look at that, analyze the asset utilization. How much are you using it on a daily basis to see whether or not that is something you want to do. And then you also want to look at how to depreciate that asset, which we'll talk about a little bit in our next module. But really think about setting that up when you're going through. So in summary, setting up this initial expenses and revenue streams for your business, it is very difficult and it's very time consuming. But these are just what we've gone through here today is just to give you the basic to start thinking about it. And there is a handout, an exercise for you about how to estimate your startup expenses, and that is available to you to work through. And for those of you that are here today, we'll be working through that as an exercise at the end of the video. So those are the types of things, some of the resources that you might have available to you that I would encourage you to look at. The score.org is a great resource for startups and also for businesses that are currently in business. They have all sorts of resources out there to help you start your business plan, to start your finances, to start to understand it. There's also different business plan calculators out there that you can also look at, and the SBA is another great source for looking at, excuse me, at analyzing your financials. So these are available to anybody. You don't have to go to a university library or public library, but these resources are available to you, especially SCORE and the SBA. Those resources are available to you because your tax dollars pay for these services. All right, so if you have any questions, I look forward to hearing them.